Megawatts on your mind from Lighthief. We build it, we run it, we know what works, real projects, real returns. The renewable energy podcast that doesn't waste your time. Let's go.
Hello and welcome back to Megawatts on Your Mind. This is Lighthief, and today we're discussing something that affects every renewable energy professional operating in Europe. The European Union's renewable energy targets. Are they realistic? Are countries actually meeting them? What happens when ambition collides with political, economic, and practical reality? The European Union has set extraordinarily ambitious renewable energy goals. By 2030, the EU aims to have at least 42.5% of its energy, not just electricity, but total energy consumption, from renewable sources. By 2050, the goal is climate neutrality, which effectively means near total decarbonization. These aren't suggestions or aspirations. They're legally binding targets that member states have committed to achieving. These targets sound impressive in Brussels policy documents and climate conference speeches. But when you're actually developing renewable energy projects across Europe, when you're navigating permitting systems, arranging financing, securing grid connections, and dealing with local opposition, you start to wonder, are these targets grounded in reality? Can they actually be achieved? And what happens to countries that fall short? The situation varies dramatically across the EU. Some countries, Denmark, Sweden, Finland, are already at or near their targets, having invested in renewables for decades. They're the overachievers who finish their homework early. Others, Spain, Germany, Netherlands, are making strong progress, deploying gigawatts of new capacity annually and plausibly on track. Then there are countries struggling significantly, Poland, Hungary, Czech Republic, where renewable deployment is far behind requirements and the pathway to compliance looks increasingly difficult. From an investment perspective, this creates both opportunity and risk. Countries behind on targets might offer attractive incentives to accelerate deployment, or they might simply miss targets and face EU penalties, creating regulatory and political uncertainty. Countries ahead might have less urgency, potentially reducing support mechanisms. Understanding where different countries stand and how seriously they're taking their commitments is essential for investment decisions. Today, we're going to explore this comprehensively. We'll break down what the EU targets actually require, the numbers behind the percentages. We'll examine different member states' progress, who's succeeding, who's struggling, and why. We'll discuss which technologies are dominating deployment and how this varies by country. We'll look at what investors and financial markets think about EU renewable targets. Are they factoring in compliance risk, or assuming governments will simply extend deadlines? And we'll address the fundamental question, are these targets realistic, or are we heading for a collective failure? At Lighthief, operating across multiple European markets, we see firsthand the vast differences in how seriously different countries take their EU obligations. Some governments have comprehensive plans, substantial funding, and clear execution strategies. Others have vague aspirations, limited budgets, and bureaucratic obstacles that prevent meaningful progress. The gap between EU target setting and national implementation is often enormous. This episode is for investors evaluating where to deploy capital, for developers deciding which markets to enter, for policy professionals wondering if current approaches are working, and for anyone curious about whether Europe's renewable energy transition is actually on track. Shall we begin? And perhaps lower our expectations before we do, because the reality is considerably more complicated than the policy documents suggest. Let's start by clearly understanding what the EU renewable energy targets actually require, because the headline percentages don't tell the full story. The current framework is the Renewable Energy Directive 3, known as RED 3, adopted in 2023. This sets an EU-wide binding target of at least 42.5% renewable energy in gross final energy consumption by 2030. There's also an indicative target of 45% that the EU should endeavor to reach. For context, the EU was at roughly 22% renewable energy in 2022. So we're talking about roughly doubling renewable energy share in 8 years from 2022 to 2030. Now, gross final energy consumption is important to understand. This isn't just electricity. It includes heating and cooling, transport, and industry. Electricity is typically the easiest sector to decarbonize with renewables. Heating and cooling is more difficult, requires heat pumps, district heating, biomass, or direct solar thermal transport is challenging, requires electrification through EVs, biofuels, or hydrogen. Industry is hardest. High-temperature heat and chemical processes are difficult to supply with renewables. The sectoral breakdown matters. The electricity sector is targeted for around 70% renewable by 2030, up from roughly 40% currently. This is the most aggressive sector target because electricity is most amenable to renewable generation. Heating and cooling should reach 42 to 43% renewable. Currently, it's around 23%. This requires massive deployment of heat pumps, renewable district heating, and building retrofits. This is harder than electricity because it requires infrastructure changes in millions of buildings. Transport should reach at least 29% renewable by 2030, up from current 9 to 10%. This is extremely challenging. It requires massive EV adoption, charging infrastructure deployment, biofuel scaling, and potentially hydrogen for heavy transport. Transport is probably the hardest sector to decarbonize by 2030. Industry has specific targets for renewable hydrogen use and renewable heat. These are the newest and least developed areas. Industry currently uses minimal renewable energy. Reaching targets requires technology deployment that's only now becoming commercially viable. Behind the EU-wide targets, each member state has national binding contributions. These were set based on countries' existing renewable energy shares, economic capabilities, and potential. Countries with high existing shares like Sweden have modest additional targets. Countries with low shares like Belgium or Netherlands have steep increases required. The penalties for non-compliance are theoretically severe. Countries missing targets can face infringement procedures, financial penalties, and reputational damage. In practice, enforcement has been inconsistent. Countries missed 2020 targets with limited consequences beyond political embarrassment. Whether 2030 target failures will be treated more seriously remains uncertain. To put this in concrete numbers, achieving the EU-wide 42.5% target requires roughly 1,100 to 1,200 gigawatts of renewable electricity capacity by 2030, up from about 600 gigawatts currently. That's adding roughly 75 to 100 gigawatts annually for the rest of the decade. Recent EU additions have been 40 to 50 gigawatts annually. So deployment needs to roughly double from current rates. For specific technologies, the implied requirements are substantial. Solar probably needs to reach 700 to 800 gigawatts EU-wide by 2030, up from current 250 gigawatts. That's adding 60 to 70 gigawatts of solar annually. Recent years have seen 40 to 50 gigawatts annually, so acceleration is needed, but not drastically. Wind needs to reach 450 to 500 gigawatts by 2030, up from current 220 gigawatts. That's 30 to 35 gigawatts annually. Recent deployment has been 15 to 20 gigawatts annually, so significant acceleration is required, particularly for offshore wind. The heating sector requires tens of millions of heat pumps installed. Current installation rates are perhaps 2 to 3 million annually, need to reach 5 to 7 million annually, requires massive scaling of manufacturing and installation capacity. Transport electrification requires EV sales to reach 70 to 80% of new vehicle sales by 2030 from current 15 to 20%. requires charging infrastructure scaling from hundreds of thousands to millions of public charging points. Looking at these numbers, the scale of transformation required is enormous. It's not impossible. The technologies exist, the cost curves are favorable, the policy frameworks are largely in place, but it requires sustained, accelerated deployment across all sectors simultaneously. Any significant slowdown or obstacle in any country or sector makes the overall target harder to achieve. The practical challenge is that EU targets are set at Brussels level based on climate modeling and political negotiation, while implementation happens at national and local levels where political priorities, bureaucratic capacity, financing availability, and public acceptance vary enormously. This gap between EU target setting and national implementation is where ambition meets reality. Let's examine which EU countries are successfully meeting their renewable energy targets and what we can learn from their approaches. Starting with the obvious overachievers, Sweden has roughly 65% renewable energy in total consumption, primarily from hydropower and bioenergy. Sweden's target is relatively modest additional increase because they're already so far ahead. Sweden benefits from enormous hydropower resources, rivers and mountains throughout the country that were developed decades ago. They also have substantial forestry industry providing biomass for heating and power. From a policy perspective, Sweden has long-term commitment to renewables dating back to the 1970s oil crises. There's broad political consensus that energy security and decarbonization are priorities. This stability enabled consistent long-term investment. For investors, Sweden is stable but offers limited growth opportunity because they're already near saturated. Incremental projects happen: wind farms, solar additions, grid improvements, but it's a mature market without explosive growth potential. Denmark has roughly 40% renewable energy, largely from wind. Denmark pioneered wind power in the 1970s to 80s and maintained consistent support for decades. They have ambitious targets to reach 100% renewable electricity by 2030 and complete fossil fuel independence. Denmark's success comes from several factors: excellent wind resources in the North Sea and Baltic. Early technology development created domestic wind industry, strong government support through feed-in tariffs, and lately auctions. High electricity prices making renewables economically attractive, and critical national consensus on energy transition with broad public and political support. Denmark also benefits from grid interconnections with Norway, Sweden, and Germany, allowing electricity trading and balancing. When Danish wind produces excess, it exports. When wind is low, it imports hydro from Norway. This regional integration enables high renewable penetration. For investors, Denmark remains attractive, particularly for offshore wind. The government continues ambitious deployment plans. The market is sophisticated with professional developers and operators. Finland has roughly 45% renewable energy, primarily from bioenergy and hydropower. Like Sweden, Finland benefits from substantial forestry resources providing biomass. They've invested heavily in combined heat and power from biomass for district heating. Finland's approach emphasizes energy security. Being partially dependent on Russian gas until recently created strong motivation for domestic renewable energy. Nuclear also plays a significant role in Finnish decarbonization strategy, complementing renewables. Austria has roughly 35 to 38% renewable energy, largely from hydropower in the Alps. Austria benefits from excellent hydro resources and has developed them extensively. They also have substantial biomass use for heating. Now, countries making strong progress toward targets, Spain is deploying renewables at extraordinary rates. From roughly 20% renewable energy in 2020, they're targeting 42 to 45% by 2030. Recent solar deployment has been spectacular, adding 5 to 8 gigawatts annually. Wind deployment is also strong. Spain's success comes from excellent solar and wind resources, streamlined permitting in many regions, favorable economics, and strong government commitment. Spain learned from previous boom-bust cycles and has implemented more sustainable support mechanisms through auctions and increasingly merchant projects. For investors, Spain is currently one of the hottest European markets. Massive pipeline of projects, improving grid infrastructure, strong developer competition returns are compressing due to competition, but absolute volumes are enormous. Germany maintains roughly 20% renewable energy in total consumption, but around 45% in electricity. Germany's challenge is heating and transport. Electricity is progressing well, but other sectors lag. They're targeting 35% total renewable energy by 2030, requiring substantial acceleration. Germany's success in electricity comes from decades of feed-in tariff support, creating the world's largest installed solar and wind base. The challenge now is integrating renewables into heating through heat pumps and district heating, and into transport through EVs. Progress is happening, but slowly. For investors, Germany remains attractive despite market maturity. The sheer scale means there's always opportunity, but competition is intense and returns are modest compared to less developed markets. Netherlands is making impressive progress from a low base, around 15% renewable energy in 2020, targeting 27% by 2030. Recent solar deployment has been strong. Rooftop solar penetration is among EU's highest. Offshore wind is expanding rapidly in the North Sea. Netherlands benefits from limited domestic fossil resources, making energy imports expensive, creating economic case for renewables. Dense population makes land availability challenging, driving emphasis on rooftop solar and offshore wind. Government support has strengthened significantly recently. For investors, Netherlands is interesting. High electricity prices support economics, strong rule of law, and financial markets. But land scarcity limits utility-scale solar focus. Is rooftop commercial, offshore wind, and innovative solutions like floating solar. The common factors among leaders and strong performers: first, excellent renewable resources, wind, solar, hydro, or biomass. Geography provides fundamental advantages. Second, long-term policy commitment. Success comes from sustained support over decades, not sporadic programs. Third, economic alignment. Where renewables are economically competitive with fossils, deployment accelerates regardless of targets. Fourth, political consensus. Countries with broad political support for energy transition progress faster than those where renewables are politically divisive. Fifth, administrative capacity. Countries with efficient permitting, capable grid operators, and functional bureaucracies implement faster than those with dysfunctional administration. The lesson for investors: these countries offer more predictable, lower-risk opportunities. They're likely to meet EU targets, meaning policy stability and continued support. But they're also more competitive and offer lower returns than frontier markets. Section 3. The laggards who's struggling and why. 10 to 12 minutes. Now let's discuss the countries that are significantly behind their renewable energy targets and struggling to make progress. This is where the gap between EU ambition and national reality is most apparent. Poland is perhaps the most challenging case. Roughly 17% renewable energy in 2023, targeting 23 to 24% by 2030. This seems modest compared to leaders, but for Poland it represents significant challenge. Poland's energy system is historically coal-dominated, around 60% of electricity from coal even now. Transitioning away from coal affects employment, regional economies, and cultural identity in coal mining regions. Poland's renewable deployment has accelerated recently, adding 3 to 5 gigawatts of solar annually, modest wind additions. But starting from low base and needing to simultaneously retire coal capacity means the transition is enormous. The heating sector is particularly challenging. Many Polish buildings use coal heating, which needs replacing with cleaner alternatives. The political economy is difficult. Coal mining regions have political power. Energy transition is sometimes portrayed as forced by Brussels rather than national choice, creating resentment. Financing energy transition while maintaining economic growth and energy security is a genuine challenge. For investors, Poland presents high risk, potentially high return opportunity, strong need for renewable capacity, improving support mechanisms, EU funding available, but regulatory uncertainty, political volatility, and grid constraints create risks. Hungary is even further behind, around 14 to 15% renewable energy, targeting 21% by 2030. Hungary has relied heavily on natural gas from Russia and nuclear power. Renewable deployment has been limited and inconsistent. Hungary's challenge includes limited renewable resources relative to leaders, modest wind resource, decent but not exceptional solar. But the bigger issue is political. The current government has been less enthusiastic about EU climate agenda, sometimes portraying energy transition as economically harmful. Policy support for renewables has been inconsistent. For investors, Hungary is challenging. Uncertain policy environment, EU funding potentially restricted due to rule of law concerns, modest market size. Some projects happen, but it's not a priority market for most developers. Czech Republic is roughly 18 to 19% renewable energy, targeting 26 to 27% by 2030. Czech Republic had early solar boom in 2010 to 2011 with extremely generous feed-in tariffs, followed by retroactive changes that devastated investor confidence. Since then, deployment has been limited. Czech renewables are primarily solar and biomass. Wind faces significant public opposition and permitting challenges. The country relies heavily on nuclear power for baseload, which reduces emphasis on renewables compared to countries without nuclear. The pathway to 2030 target is unclear. Current deployment rates are insufficient. Nuclear expansion is planned but won't come online by 2030. Substantial renewable acceleration is needed, but policy frameworks remain uncertain. For investors, Czech Republic requires caution. The retroactive solar policy changes created lasting damage to investor confidence. Until there's sustained evidence of stable, supportive policy, many investors avoid Czech market. Belgium is around 13 to 14% renewable energy, targeting 23 to 24% by 2030. Belgium is densely populated with limited space, constraining onshore wind and utility-scale solar. Offshore wind in the North Sea is the main large-scale renewable opportunity. Belgium's federal system creates complexity. Regions have different policies, sometimes conflicting. Nuclear phase-out plans keep changing, creating uncertainty about electricity supply and renewable requirements. Political fragmentation means energy policy lacks consistency. For investors, Belgium offers limited but specific opportunities. Offshore wind if federal government proceeds with auction plans. Rooftop commercial solar where economics work, but market size and political uncertainty limit appeal. Romania has roughly 24 to 25% renewable energy. Seems okay compared to others. But much of this is legacy hydro and biomass. Recent renewable deployment has been limited despite excellent resources. Romania needs to sustain higher share as economy and energy consumption grow. Romania's challenges include grid infrastructure that needs massive investment, bureaucratic capacity that's often inadequate, and political instability, creating policy uncertainty. We discussed Romanian market in our Central Asia episode. It has potential but requires experienced emerging market developers. Bulgaria and Greece are similar to Romania. Decent renewable resources, modest progress, administrative and political challenges limiting deployment speed. Both could make progress but need improved policy frameworks and implementation capacity. The common challenges among laggards. First, fossil fuel entrenchment. Countries historically dependent on coal or gas face economic and political obstacles to transition. Employment in fossil industries, existing infrastructure investments, cultural attachment to traditional energy sources. Second, limited administrative capacity. Efficient permitting, grid connection processes, support mechanism implementation, all require capable bureaucracy. Countries with dysfunctional or overwhelmed administration struggle to implement policy even when political will exists. Third, political instability or lack of commitment. Energy transition requires sustained multi-year effort. Countries with frequent government changes or lacking political consensus struggle to maintain consistent policies. Fourth, grid infrastructure deficits. Adding substantial renewable capacity requires grid investment. Countries with weak or outdated grids face expensive, time-consuming reinforcement requirements that slow deployment. Fifth, financing challenges. Countries perceived as higher risk face higher costs of capital. This makes renewable projects less economically attractive, requiring higher support levels that governments might be reluctant or unable to provide. The practical implication, many countries will miss their 2030 targets. The question is, by how much and what consequences follow? Will EU enforcement be strict, creating genuine penalties, or will targets be quietly revised or deadlines extended, maintaining political cover while acknowledging reality? For investors, these struggling countries present dilemmas. They need investment desperately, possibly offering higher returns, but the risks are substantial. Policy uncertainty, execution challenges, potential for missing targets leading to political or regulatory turbulence. Let's examine which renewable energy technologies are dominating deployment across Europe and how this varies by country, because understanding the technology mix is essential for investors and developers. Starting with the overall European picture, solar photovoltaic is currently the fastest growing renewable technology. European solar additions in 2023 were roughly 55 to 60 gigawatts. This represents acceleration from 40 gigawatts in 2022 and around 25 gigawatts in 2021. Solar is growing fast due to dramatic cost reductions. Modules from China are historically cheap and relatively simple deployment compared to wind. Wind additions were roughly 15 to 20 gigawatts in 2023, continuing the pattern of recent years. Wind growth is more constrained than solar, primarily due to permitting challenges for onshore wind and the longer development timelines for offshore wind. But wind remains essential for reaching targets due to its higher capacity factors and complementary generation profile to solar. Biogas and biomass growth is modest, perhaps adding 1 to 2 gigawatts equivalent capacity annually. These technologies are mature, and deployment is limited by feedstock availability and environmental concerns about sustainability. Hydropower is essentially constant. Most European hydro resources are already developed. New hydro projects are small and limited by environmental regulations protecting rivers. Existing hydro provides essential storage and dispatchability but doesn't grow significantly. Now, how does technology mix vary by country and why? Southern European countries, Spain, Italy, Greece, Portugal, are emphasizing solar. This is logical given excellent solar resources. Spain is adding 5 to 8 gigawatts of solar annually, Italy 3 to 5 gigawatts. These countries also have wind, but solar is driving volume growth. The economics favor solar in sunny climates. Capacity factors in southern Spain or Greece approach 25 to 30%, making solar very competitive. Land is relatively available and inexpensive in rural areas. Permitting, while not trivial, is generally faster than wind. For investors, Southern European solar offers reasonable returns at scale. Competition is increasing, compressing margins, but the volumes support large deployments. Central European countries, Germany, Poland, Netherlands, Belgium, have more balanced solar and wind deployment. Germany adds roughly 10 gigawatts of solar annually and maintains 2 to 3 gigawatts of wind additions, Despite onshore permitting challenges, Poland adds 3 to 5 gigawatts of solar and around 1 gigawatt of wind. The balanced approach reflects moderate solar resources, making wind equally or more attractive from energy yield perspective. Germany's energy transition requires both technologies at scale. Poland's rapid solar growth is partly catch-up from historical low levels. Northern European countries, Denmark, UK, Nordic countries, emphasize wind, particularly offshore. Denmark and UK are offshore wind leaders. Onshore wind continues in areas with good wind resource and community acceptance, particularly Scotland and Nordic countries. This makes sense given limited solar resources in northern latitudes. Winter production in Denmark or UK is negligible. Wind resources are excellent, especially offshore wind achieves capacity factors of 45 to 55% in North Sea, far better than Northern European solar's 10 to 15%. For investors, Northern Europe means primarily wind projects. Solar is mostly small-scale rooftop where it serves self-consumption rather than large utility-scale farms. Eastern European countries, Poland, Romania, Czech Republic, Bulgaria, are currently solar-dominated for new capacity. This reflects solar's lower development complexity, faster deployment, and avoided permitting battles that plague wind. Poland's gigawatts of annual solar additions contrast with limited wind due to onshore wind distance requirements from buildings that effectively ban wind. In much of the country, Romania and Bulgaria have excellent wind resources, but permitting and grid challenges slow wind development. This technology mix creates potential problems for system integration. Solar-heavy systems face challenges with winter production gaps and evening peaks. Countries adding primarily solar need to simultaneously plan for storage, demand response, and grid interconnections to manage solar intermittency. Biogas deployment varies significantly by policy. Germany's generous historical support created Europe's largest biogas sector. With 9,000 plus plants, Italy has substantial biogas, particularly from agricultural and food waste. Most other countries have modest biogas deployment. Future biogas growth focuses on biomethane for gas grid injection rather than electricity generation. Several countries are targeting significant biomethane production by 2030 as renewable gas can substitute for natural gas in existing infrastructure. Storage deployment is accelerating, but from low base. Battery storage additions are reaching 5 to 10 gigawatt hours annually across Europe, driven by solar integration needs and frequency regulation opportunities. This will need to grow much faster to support high renewable penetration. The practical implications for reaching EU targets. First, solar will drive volume. It's fastest to deploy, cheapest per megawatt, and acceptable to permitting in most countries. Expect solar to provide perhaps 60 to 70% of renewable capacity additions through 2030. Second, wind is essential despite slower deployment. Solar alone cannot provide sufficient energy in winter or northern countries. Wind must accelerate, particularly offshore, where permitting is less constrained than onshore. Third, technology mix must be balanced regionally. Countries cannot rely solely on one technology without creating integration challenges. Systems need both solar and wind for temporal and seasonal balance. Fourth, storage becomes critical at high renewable penetration. Current storage deployment is far below requirements for 70% renewable electricity. Storage must accelerate dramatically, 2025 to 2030. For investors, the implications are clear. Solar offers volume and relatively predictable returns across most European countries. Wind offers better energy yields but longer development and higher risks from permitting. Storage is emerging opportunity with high growth potential but less proven economics. Biogas is niche opportunity where policy supports it. The technology mix question is fundamentally about matching resources, economics, permitting realities, and system integration requirements. Countries optimizing across all these factors progress fastest toward targets. Those focusing too narrowly on one technology or ignoring integration challenges face obstacles. Right. Let's discuss what investors and financial markets actually think about EU renewable energy targets. Are they pricing in compliance, failure, or muddling through? Where is capital flowing and why? Starting with the institutional investor perspective. Large infrastructure funds, pension funds, insurance companies, the institutional capital that finances most utility-scale renewable projects generally take EU targets seriously. They view renewable energy investment in Europe as relatively safe infrastructure investment aligned with long-term decarbonization trends. However, institutional investors don't assume all countries will meet targets equally. They differentiate based on track record and perceived execution capability. Germany, Netherlands, Denmark, Spain, viewed as likely to meet or nearly meet targets, creating stable policy and market environments. Poland, Hungary, Romania, viewed as higher risk but potentially higher return, with meaningful probability of target misses, creating policy volatility. Capital flows reflect this assessment. Spain has attracted enormous renewable energy investment recently, tens of billions of euros from international developers and funds. Germany continues attracting substantial capital despite market maturity. UK remains attractive post-Brexit. These markets are viewed as relatively safe with predictable policy frameworks. Eastern European markets attract less capital proportionally despite potentially higher returns. The perceived execution risk, permitting delays, grid issues, policy uncertainty, makes many institutional investors cautious. Capital that does enter these markets typically demands higher returns to compensate for higher risks. Project finance banks, the commercial and development banks providing debt for renewable projects, similarly differentiate by market. Spain, Germany, UK, Nordic countries, relatively easy to finance with favorable terms, perhaps 60 to 70% debt at competitive rates. Poland, Romania, Bulgaria, more difficult, requiring more equity or higher interest rates, typically 50 to 60% debt. The cost of capital differences are meaningful. A project in Spain might achieve 3 to 4% interest on senior debt. The same project structure in Romania might face 6 to 8%. This 3 to 4 percentage point difference significantly affects project returns, creating self-fulfilling cycles where low-risk markets attract more capital at better terms, accelerating deployment, while high-risk markets struggle to finance projects. Green bond markets have exploded, reaching hundreds of billions of euros annually in Europe. These bonds finance renewable energy and other climate-aligned investments. The growth demonstrates strong institutional demand for climate-related investments. EU taxonomy regulations classify what qualifies as green, channeling capital toward approved technologies and sectors. For renewable energy developers, green bonds provide attractive financing, complementing traditional project finance. Large developers like Ørsted, Iberdrola, Enel have issued billions in green bonds. This capital availability supports ambitious deployment plans. Private equity and infrastructure funds have raised enormous capital for renewable investments. Hundreds of billions are available for deployment, creating intense competition for quality projects. This capital abundance supports target achievement by ensuring financing isn't a constraint for viable projects. However, capital abundance also compresses returns. When too much money chases limited opportunities, prices for projects increase and expected returns decline. Some mature markets now see auction prices barely covering costs, with developers accepting minimal returns hoping to achieve scale and operational excellence. The public equity markets, renewable energy stocks traded on exchanges, provide interesting signals. Renewable energy stock performance has been volatile, strong performance 2019 to 2021 when climate commitments strengthened. Poor performance 2022 to 2023 when interest rates rose and inflation increased costs, recovery in 2024 as conditions stabilized. This volatility reflects that while long-term trends favor renewables, near-term profitability is sensitive to financing costs, equipment prices, and policy stability. Investors believe in long-term growth but worry about near-term execution and returns. The analysis from financial institutions generally concludes, first, aggregate EU targets are probably achievable with significant effort. The technology exists, costs are favorable, policy frameworks are largely in place, but it requires sustained acceleration of deployment and no major disruptions. Second, individual country targets are highly variable. Some countries will exceed targets. Others will miss significantly. The EU-wide average might approach target even with substantial country-level failures. Third, electricity sector targets are most likely achieved. Solar and wind economics are favorable. Deployment is accelerating. 70% renewable electricity by 2030 is challenging but plausible. Fourth, heating and transport targets are at risk. These sectors are transforming more slowly. 40+% renewable heating and 29% renewable transport by 2030 require heroic deployment rates for heat pumps, EVs, and supporting infrastructure. Many analysts view these as unlikely without extraordinary policy intervention. Fifth, storage and grid infrastructure are critical constraints. Current deployment rates are insufficient. Underinvestment in grids and storage could limit how much renewable capacity can actually be utilized even if built. The practical investor approach is selective market entry. Invest heavily in markets with strong fundamentals and execution track records. Take measured bets on higher risk markets where returns compensate for uncertainty. Diversify across technologies and geographies to manage portfolio risk. For developers, the financial market signal is clear. Capital is available at scale for European renewable energy, but it's not indiscriminate projects must demonstrate clear economics, manageable risks, and realistic execution plans. The days of build it and capital will come are ending in mature markets. Professional execution and competitive economics matter increasingly. The renewable energy sectors where capital is most interested currently, offshore wind remains attractive despite higher costs because of scale potential and policy support. Major offshore wind developers have no trouble raising billions for expansion plans. Utility-scale solar in high irradiation markets like Spain continues attracting substantial investment despite increasing competition. Commercial and industrial rooftop solar where self-consumption economics work independent of wholesale prices. Battery storage is increasingly attractive as business cases improve and renewable integration requires storage. Green hydrogen is attracting investment despite immature technology and uncertain economics because of its potential role in hard-to-decarbonize sectors. The sectors facing capital constraints or skepticism. Onshore wind in markets with permitting challenges struggles to attract capital when development timelines and outcomes are uncertain. Small-scale residential solar in markets where support has been reduced and returns are marginal. Biogas without clear feedstock supply and stable long-term offtake. Projects in politically unstable markets without strong risk mitigation. The market verdict, European renewable energy targets are aggressive but not impossible. Capital is available to support deployment at levels approaching what's required, but execution matters enormously. Countries and projects with strong fundamentals, clear plans, and professional execution will succeed and attract capital. Those with weak fundamentals, political uncertainty, or poor execution will struggle. So we've explored EU renewable energy targets comprehensively. What's required, who's succeeding, who's struggling, what technologies dominate, and what investors think. Key takeaways. The EU targets are extraordinarily ambitious. 42.5% renewable energy by 2030 requires roughly doubling current rates of deployment and expansion into heating and transport sectors. These targets are achievable technologically and economically, but require sustained political commitment and effective implementation. The picture across member states is highly variable. Leaders like Denmark, Sweden, and Finland are already at or near targets. Strong performers like Spain, Germany, and Netherlands are making impressive progress. Laggards like Poland, Hungary, and Czech Republic face significant challenges reaching targets. The technology mix emphasizes solar for volume due to cost and deployment speed, but requires balanced approach, including wind for energy security and seasonal production. Storage must accelerate dramatically from current levels. Heating and transport sectors need revolutionary transformation, not just incremental improvement. Investors view European renewables favorably overall, but differentiate significantly by country and technology. Capital flows to markets with strong fundamentals, stable policies, and execution track records. Higher risk markets attract less capital and face higher financing costs, creating self-reinforcing cycles. The realistic assessment. Europe will probably achieve something close to aggregate targets in electricity sector by 2030, though many individual countries will fall short. Heating and transport targets are at serious risk of missing significantly. The 2050 climate neutrality goal remains achievable, but requires dramatic acceleration beyond current efforts. The consequences of target misses remain uncertain. Will EU enforcement be strict, imposing meaningful penalties on non-compliant countries, or will targets be quietly revised, deadlines extended, creating political cover while acknowledging reality? The answer affects investor confidence and policy credibility. For renewable energy professionals, the message is clear. The next decade offers enormous opportunity in European renewables. Deployment will accelerate regardless of whether exact targets are met, but success requires understanding market-by-market dynamics, technology-specific opportunities, and realistic assessment of execution risks. The countries treating targets seriously, implementing effective policies, streamlining permitting, investing in grids, and creating stable investment environments will attract capital and achieve or exceed targets. Those using targets as aspirational statements without backing them with action will fall short and struggle to attract investment. In future episodes, we'll continue exploring renewable energy across technologies, markets, and operational realities. We'll provide practical insights from actual project experience rather than policy documents and aspirational statements. This is Lighthief, reminding you that targets matter, but execution matters more. Europe's renewable energy targets are impressive on paper. Whether they translate into actual megawatts of clean energy depends on thousands of individual project decisions, financing arrangements, permit approvals, and policy implementations across 27 countries. The targets are ambitious, the reality is complicated. But the direction is clear. European renewable energy will continue growing substantially, even if the exact pace and distribution don't perfectly match Brussels' spreadsheets. Until next time, may your projects receive permits, your financing close successfully, and your optimism about EU targets be tempered with practical realism about what's actually achievable.